Next up on our revision schedule is budgets. Now, budgets is a fairly simple topic, very, very easy, quick, very fast. Now, you have only two types. You have the flexible budgets and the functional budgets. Now, when you're making the flexible budgets, what do? You have a budget at one level of activity. You have to be make budgets at different levels of activity. Okay. Key important over here to understand and remember is cost behavior. Okay. Now, the cost behavior will be of three types. You will have the fixed cost, the variable cost, and the semi-variable cost. Fixed cost will remain same on total basis. So the totality remains same. The per unit keeps on changing. Variable cost, the per unit remains the same and the total changes. And this is same on neither. The only thing that you have to do under a flexible budget is to figure out the cost behavior, whether a cost is fixed cost, variable cost, and semi-variable cost. Okay. Now we have two categories over here. Okay. The first category where you have only one cost at one level. Okay. One cost at one level. I'll give you an example for that. Wait. Like over here, you have only one cost at one level. Okay. Now, when this is the case, you determine whether a cost is fixed variable or semi variable based on the name of the cost. Okay. All direct costs are always and always going to be variable. Keep that in mind. All direct costs are variable. Okay. So, on that basis, we decide whether a cost is fixed or variable or semi variable. Okay. Once you are done with this, okay, you've decided whether a cost is fixed or variable or semi-variable. The only thing that you have to do is multiply with the number of units. Okay. Now, if a cost is semi-variable, here they will tell you how much is fixed and how much is variable. You will segregate it, and always keep this one thing in mind. Variable cost always expressed on per unit, fixed cost always expressed on totality. Okay. Now, let's talk about this right now that we have over here in our example. The semi-variable selling expenses 20% is fixed, which means the balance 80% is variable, right? So out of 15 into 80%, 12 is variable. 3 is fixed, but you do not express your fixed cost on a per unit basis, you express it on totality, right? Now, since you express that on totality, this 3 per unit will be multiplied with the number of units for which this budget is given. This budget is given for 20,000 units. So, you will be multiplying this 3 per unit with the number of units for which this budget was drawn. If this budget was drawn for 15,000 units, you would have done 3 into 15,000. If this budget was done for 25,000 units, you would have done 3 into 25,000. Are we understanding? So, always and always for which the budget is given is what you will multiply it to get the fixed cost. So, here our fixed cost would be 60,000. That's 3 into 20,000. Are we understanding? So this is the fixed cost. Okay. Always express your fixed cost on totality basis, variable cost on per unit basis. Okay. Now, always to add to it, fixed cost expressed on totality, modified also, fixed cost expressed on totality, modified also on totality basis. Variable cost expressed on per unit, modified also on per unit basis, which is actually the next question after that. Any changes that you're going to do has to be done for variable cost on a per unit basis, for fixed cost on totality basis. Keep that thing in mind. Okay. Now, that was one type where we did not have cost at more than one level. So we decided whether the cost is fixed variable or semi variable by the name of the cost. Okay. Now, when it comes to this type of a question, okay, where you have cost at more than one levels, okay, so over here you have cost at 55,000, 65,000, 75,000 units, you have cost at more than one levels. Whenever you have cost at more than one levels, what you do is you mathematically see whether a cost is fixed variable or semi variable. You will have to check it mathematically, okay. Now, for example, 11 lakhs is the cost of 55,000 units. You divide, you get a per unit. 13 lakhs is the cost of 65,000 units. 15 lakhs is the cost of 75,000 units. You divide and then see whether the cost is fixed variable or semi variable. But how do we do that? Once you've divided, If the per unit is the same, then that cost will become a variable cost. If the total is the same, then that cost is a fixed cost. And if neither of it is the same, neither the per unit is the same, nor the totality is the same, then in that case, that number will become a semi-variable cost. And once you decide that whether the cost is semi-variable, you will have to use the formula which we've used multiple times. Change in total cost upon change in units, this will get variable cost per unit. And then you will take any one level over here, let's say at 55,000 units, the total cost is 3,10,000. So you will have variable cost and fixed cost. The variable cost is per unit we have found out over here. So into 55,000 units, that much is the variable cost, and this is your fixed cost, the balancing figure. So you'll have to segregate it on that basis. Okay. So keep this thing in mind. When it comes to flexible budgets, you have two types. One, where you have cost at only one level. Second, where you have cost at more than one level. If you have cost only at one level, you will decide the behavior based on the name of the cost, whether the cost is fixed or variable or semi-variable. If you have cost at more than one level, you will have to mathematically see whether the cost is fixed variable or semi-variable. When you are seeing mathematically, how do you do that? You divide the cost by the number of units and find out the per unit. If the per unit is the same, then that cost is variable. If the totality is the same, then that cost is fixed. And if it is same at neither of the levels, then that cost is semi-variable. Are we understanding? No, you have these two categories in terms of flexible budgets. Now when it comes to functional budgets, okay, when it is functional budgets, for this category you have to follow the format, the flow of functional budgets, which starts off with sales, add closing finished goods less opening finished goods to get production into the raw material required, will get consumption budget, add closing raw material, reduce the opening raw material to get the purchase budget. This purchase budget will be in units. This entire thing runs on units. Okay. This entire thing will run on units. They may ask you purchase budget and value. So all that you have to do is multiply by the purchase price to get the purchase budget and value. Are we understanding? Now, when it comes to this, what are the things that you have to keep in mind? Firstly, time frames. Sometimes they may ask you the budget on a monthly basis. Sometimes they may ask you on a, quarterly basis. Sometimes they may ask you on an annual basis. Okay, so be very very careful of the time frame in which they are asking. See, because you giving them an answer on monthly basis when they've asked quarterly, or vice versa, is not going to get you marks. So what you have to do is you have to make sure that whatever is the time frame asked in the required is the time frame in which you're presenting your answer. Okay. Apart from that, the format is fairly straightforward. You don't have a lot of things to do, but there are a few questions which are very very interesting, which I'm gonna mark for you, which you'll be trying. Okay. Uh, 1 second. So in terms of flexible budgets, what I want you to try out a day before exam, I think you should be trying question number 5. That's a good one. You should be doing 7. Good question. You can do the ninth. You can do the 10th. That's all. In terms of functional budgets, you can take up 13. 13 is simple. You can take up the 19th question, 20th, 21st can be done, 22nd, the later portion of the budget question, 23, very good question, and 25. Oh, in fact, you know what, 24 as well. Only for one reason, they have asked the usage budget in quantities and rupees both. Usage budget is your consumption budget. Okay. So all of the latter portion of the functional budgets are important. And then comes in your budget ratios. Budget ratios are fairly simple. Do not skip them. This becomes a good MCQ contender according to me. I think this will form a good MCQ contender. So you should be focusing a little upon the budget ratios. Only three ratios. Now the question may ask you specifically for budget ratios. Uh, as in, they may ask you to do the efficiency ratio and the activity ratio and the capacity ratio individually, or they may just randomly tell you drop the budget ratios. And if that is the case, when you're drawing up the budget ratios, then they're asking all the three together. So be a little careful there. But apart from that, good chapter, simple questions. Hope that you get from this chapter. Okay. So, okay, guys. The next topic that we're doing is overheads. Now, as you know, overheads is kind of a pain point chapter for a lot of you, but trust me, it's fairly mechanical, and you just have to figure out the mechanics. That's all. Yeah. Once you are able to do that, I am very sure you'll be able to crack open the questions easily. Okay, so I'm going to quickly revise and summarize the entire chapter for you, and also give you the important questions at the end of the chapter after the end of the summary. Try doing those much a day before exam. I'm sure you'll be able to open up the questions in the paper as well. Now, overheads as a chapter, the first leg is of course the distribution summary. Okay, then comes in the machine hour rate. Then is over and under absorption, and lastly, my favorite, the miscellaneous section. Okay, so I have four legs for this particular topic. Now, let's talk about distribution summary in depth. Distribution summary is where you are categorizing the production departments and service departments as two different departments. Okay, now, what is the production department? Where the production is happening. What is the service department? Service department's job is to service the production departments. Okay, now I'm sure you remember me saying this a lot. The one who benefits is the one who pays. Okay, so the same logic happens on overheads as well. The service departments are servicing the production department. So the production department is benefiting from the service department. Since the production department is benefiting from the service department, the cost of service departments have to be borne by the production departments. Okay. Now, while doing this, that is, while you're distributing the cost of the service department to the production departments, it has a number of methods, it has a number of assumptions. The first assumption is where service department only serves production department and no one else. Okay, so the service department will only service the production department, it will not serve anybody else. As in, by anybody else, I mean by other service departments. It will not serve any service department. They will be doing only and only services to production department. This is called as your direct distribution or redistribution method. Okay, this is the first one. Under the second assumption, one service department will service other service departments and will not take service back. Okay, so now what is happening is one service department is serving another service department, but it doesn't take service back. Okay, now since this is a one-way street, this method is called as non-reciprocal method. Okay, and the non-reciprocal method may also be called as the step ladder method. It may also be called as the step ladder method. Okay, and the third one, very very common, is service departments service each other and production departments. Okay, they service each other and production departments, all of them. Now, this, since there is give and take, this method is called as the reciprocal method. And under the reciprocal method, you have three methods. You have the simultaneous equation method, you have the trial and error method, and you have the repeated distribution method. Okay. Now, how do you spot which method is given? So, non-reciprocal method is easier to spot because there is only give of service, no take of service. Under the reciprocal method, there is give and take both of service. So X will serve Y, Y will serve X, A will serve B, B will serve A, like that. And under the first method, you are only and only giving to the production departments, no amounts given to the service departments at all. That is how you'll spot whether it is a direct distribution method or not. Okay. Now, when it comes to solving questions, okay, under this distribution summary, the first step that you do is allocation. Okay. Now, what is allocation? These overheads are already given for a particular department. These are already given for a particular department. They are already known. Everything is done. Okay. It is already divided to them. Then comes in the next stage, which is apportionment. Now, how does apportionment work? These are costs which are common for all the departments, and you have to divide them between the departments using some basis of apportionment. This is where area in square feet, capital value of assets, machine hours, labor hours, direct wages, all of these bases that you get in the question are used. Okay. Now, allocation plus apportionment will give you overhead as per primary distribution. And then after the primary distribution comes in the reapportionment. Now, reapportionment is where service department costs are transferred to the production department. And over here, these three methods are applicable, whether it is a direct distribution or non-reciprocal or a reciprocal method comes in the reapportionment stage. Okay, so it happens then, not before that. Allocation and apportionment will be done irrespective of what method the question is. Allocation and apportionment has to be done any which ways. Only after that you will have the reapportionment, and under the reapportionment is when you will decide whether the service department costs that are to be transferred to production department, is it via direct distribution or non-reciprocal or the reciprocal method. Are we understanding? So that is what you have to keep in mind, and once all of this is done, you will get overhead as per secondary distribution. Okay, these are overheads as per secondary distribution that you actually have to calculate. Okay, this is your final stage. There may be one additional thing that they may ask you, is that you divide it by some number of hours. They may give you production hours or working hours or machine hours or something to get the overhead absorption rate. Okay, this is what you have for the distribution summary. The distribution summary questions My personal suggestion would be to do one of each of the type just to get a hang a day before exam to complete it. Okay, and we have around 15 questions, but we have done only until question number 12. We haven't done 13, 14, 15. Don't do them. From the first 12 questions, just pick one question out of each of the distribution summary. Now, things that you have to keep in mind when it comes to distribution summary questions is in the non-reciprocal method or the step ladder method, you will first put down the service departments and then put down the production departments. And in the service department, you will put down the service department that is serving everybody first. So let's say X is serving Y. Y does not serve back. Okay, so you will write X, Y, and then AB. Okay, and very important is when you're putting down the ratios in this, always look into the matching concept. What is the ratio for Y? They may give you the ratio of A is to B is to Y as 6 is to 4 is to 2, but you are writing Y, A, and B. So for you, the ratio has to be 2 is to 6 is to 4. Are we understanding? There is a very important difference over here. You cannot just divide the numbers as it is, because the ratio that you may be given in the question and the order in which you have written your answer may be different. So if the answer is different, in the format is different, the alignment is different, please make sure that you're rechecking the ratio in which you're writing the numbers. Otherwise, it will be a bigger problem. Okay. Now, once this is done, the distribution summary, the second stage that you have is the machine hour rate questions. Now, these questions are purely and purely service costing based questions. You don't have anything different or fancy happening over here. They are all the same. Okay. Only thing that you have to do is when you're doing the machine hour rate, basically what you're trying to do is find out the cost per machine hour. And when you're doing cost per machine hour, anything before the per is your numerator. So the numerator becomes total cost. And anything after the per is your denominator, which is your total machine hours. Are you understanding? That's what the total cost upon total machine hours, that will get you your machine hour rate. Now, what are the things that you have to keep in mind in this particular segment of question? First, time frames. Very, very important. They may give you the cost in days, weeks, months, year, whatever. Okay, but you will have to all bring them to the same time frame. Now the bigger question is which time frame. So my suggestion, always and always, if you have been given the machine hours on month basis, then find your cost also on month basis. If your machine hours are given on day basis, find your cost for a day, and if they're given on an annum basis, then find your cost per annum. Why? Because 2400 machine hours per annum is not equal to 200 machine hours per month. Okay, that's not how it works. The 200 machine hours per month that you can mathematically derive does not happen, particularly in machine hours, because there are periods of demand and slack. So, in periods of demand, you may actually want to work for 400 machine hours in a month as well. And in periods of slack, you may not want to work for 200 machine hours in a month as well. Okay, so it varies. And now, since it varies, you can't really mathematically derive and find a number. Okay, which is why never bother of tampering the number in the first place. Just simply, if the numbers are given per month or per day or per annum, if the machine hours are in any of the time frame, make the cost as per that time frame. Okay, you can do the cost as per that time frame. Okay, now when it comes to the cost element of it, all of the costs are fairly simple, but one of the categories of costs that you may come across is departmental overheads or departmental costs. Now, key important term over here to understand and remember is departmental. Okay. If the cost is departmental, meaning it is for the entire department, and it will be applicable for all of the machines that are in that particular department. So for example, if the departmental costs are 10,000 rupees and you have four machines in that department, then that 10,000 rupees is the cost for all the four departments put together. So it will be for one machine only 2,500 rupees. Keep that in mind. While you're reading the cost, please be sure of departmental costs. Second is electricity. Okay, electricity or power. Okay, now power is presumed to be used only during the productive hours. Now you may ask, what are productive hours, sir? So your total hours will be divided between productive and non-productive hours. Okay. Now, what are the productive hours? Where the work is happening. What are the non-productive hours? Obviously, when the work is not happening. Now, you have two categories of non-productive hours with you. Okay. The first type of non-productive hours that you have is maintenance, and the second type of non-productive hours that you have are setup. Okay, maintenance and setup are primarily assumed to be of non-productive nature. Okay, the productive hours are anything which is not maintenance and setup hours. Everything else are productive hours. Okay, now when I say it is primarily assumed to be non-productive is because the question may choose to call this as productive hours also. Okay, and if the question chooses is to call it as productive hours, then include it into productive hours. Okay, don't battle with the question. The question says these are productive hours, go ahead, make them productive hours. Okay, now electricity and power is presumed to be only on the productive hours and not on the non-productive hours. Okay, unless otherwise mentioned. If the question says that in the non-productive hours also you are using electricity, great, charge electricity on all of them. But if the if the question is silent, we always assume that the power will be only and only on productive hours and not the non-productive hours. Okay, now this is what you will have to take care in mind for your total cost aspect. When it comes to the total machine hours, your machine hours have to be the one that you're going to divide it has to be only productive hours. You will divide the cost only with the productive hours. So basically, you have to remove the non-productive hours as you have for maintenance and setup. Under the name of maintenance and setup, those hours are considered as non-productive, and you will be reducing all of them. Okay. This is what you have to keep in mind for your machine hour rate. Now, when it comes to under and over absorption. Now, how does under and over absorption work? What happens under and over absorption of overheads? So you put down the overheads absorbed, you match it with the overheads incurred, and then you find what is under absorbed. Okay. Now, when you say overheads absorbed, what do you mean by that? So overheads are charged or absorbed or applied on a certain basis. So it could be machine hours or labor hours or whatever. Okay, let's say it is 10 rupees per machine hour. Okay, and you have actually worked for 10,000 hours. So your overheads absorbed will be actual machine hours or actual hours into overhead per hour. So let's say you have actually worked for 10,000 hours. 10,000 hours into 10 per hour, that will give you your 1 lakh rupees. These are your overhead absorbed. And let's say the overheads incurred are 1 lakh 20,000. So you were able to recover. See, understand this, remember this. Absorbed is to recover. Okay. You were able to recover 1 lakh, but you spent against that 1 lakh 20,000. So you recovered 1 lakh rupees, but you in against that you spent 1 lakh 20,000. This is an under absorption of 20,000 rupees. And now this under absorption, how will this be taken care of? What do you do with that? So if you find an under absorption, you will have to first find out, is the amount significant? I'm sure you remember that table, that flowchart that we did. Is the amount significant? If the answer is yes, and the answer is always yes. If the answer is no, you can transfer to costing P&L. The next question that you ask is it due to own mistake? Is it due to own mistake? If the answer is yes, then again transfer the amount to costing P&L. If the answer is no, then you create a supplementary rate. Okay. Now, in the under absorption that you have, they may tell you that some of it is out of your own mistake, planning mistake, defective planning, this, that, etc. So that much portion you will transfer to costing P&L. The balance portion you will create a supplementary rate. Now, the supplementary rate is the additional rate that you have. Okay. Now, when you say additional rate, it is charged on the products that you have. Okay. So, we will have to find out the production in that particular period of finished goods and WIP both. Okay. Now, let's say the supplementary rate is for 10,000 rupees, where 10,000 rupees is not due to our own mistake, it is due to inflation in cost. Now, that 10,000 rupees that you have, this is for which you will create a supplementary rate. Now, your supplementary rate has to be for the production of finished goods and WIP. Let's say the production of finished goods are 8,000 units, and this is 2,000 units of WIP. So that's a total of 10,000 units. So your supplementary rate is 1 rupee. Okay. Now your supplementary rate is 1 rupee. How? That is the amount divided by the number of units. Please be sure that you are including both the finished goods and WIP, both the units together. They may tell you WIP is 50% complete, so convert it into 50% and then put across. But please make sure that you are putting that across. Okay. Now, you got your supplementary rate. Now you have to charge finished goods account, cost of sales account, and WIP account. The finished goods account for whatever is kept in finished goods stock. The COS account for whatever is sold. And for WIP, whatever is kept as WIP stock. Okay, so these are the units that you will be given. They will say that you have 2,000 units in finished goods, you have sold 18,000 units, you have 5,000 units in WIP, all of that. So whatever are the units into the supplementary rate that you have to you've got. Okay, so that ways you'll be able to do each and every question. It's a very simple category. Just do one or two questions out of it and you'll be done. I'll mark the questions for you now. One thing that you will have to keep in mind is sometimes they give you some one-off expenses, paid as per court's order, previous year expenses booked in the current year, etc., something like that. Now, whenever they give you that, these overheads, these are technically not overheads. These are those costs which are included in overheads because we don't have any other head of cost. Since we don't have any other head of cost, we are putting it as overheads, but they are not technically overheads. Now, in such a situation, when they're not technically overheads and you're still adding as overheads, what do you do? It will be included in the amount overhead incurred. Since it is included in the overhead incurred, you will have to reduce it down. So let's say overheads are 1,50,000 incurred. Okay, overheads are 1,50,000 incurred, and 30,000 out of it is paid as per court's order. So you will reduce that 30,000 and you will say that your overheads are only 1,20,000 rupees. That's all. Are we understanding? So that is what you have to keep in mind for the under absorption for the overhead incurred portion. Okay. Now, after this comes in the last stage, which is the miscellaneous category. These are all different types of questions. There is no particular methodology or particular way of doing them. These are all different types. I would want you to try all of them. Okay, and now for the important one, the list of important questions that you should you can try looking at them one day before exam. I want you to do question number one, 3, 4, 5, and 6. These are all your distribution summary questions. Okay, the very one category, one type of each question. This is why we have these many number of questions. Then fast forwarded to question number 15. From 15, don't need to do 15. 15 is very basic. You can try doing the 16th one, 18th one, or 19th, very important. 20th, the two tier rate, very, very important. 23 is something that you can do. And from the under and over absorption section, just randomly do two questions. Do the 25th question, do the 27th question, and this is where the miscellaneous portion begins, kind of. Uh, 31st, if you have the time, do it. If you don't have the time, it's okay. Okay, just look through the solution at least once. 32 and 33 are same. Do not do 34, it is still a cancelled one. 35th question, it's okay if you don't. 36 is very basic, so is 37. And try doing the 30th question. Okay, that's all that I would recommend you to do a day before your exam when it comes to overheads. But trust me, the numbers are large, but the calculations are fairly simple in this particular problem chapter. So be a little agile while solving it. That's all. Be a little, have a little presence of mind, and I'm sure you'll be able to do it just fine. Okay, so that's it from the overhead chapter. I think it's time for us to look into the next one. Okay, guys, the next chapter that we are going to do is process costing. Now, for process costing, you don't have a lot of types of questions. You have the basic type, the equivalent production type, under which you have weighted average and FIFO, and then you have the miscellaneous type. Okay, we'll quickly revise this from our formula book. I think that will be the best for you to quickly understand all the nuances. Mm, hold on. Okay. Uh, so for the basic process account, you'll have three accounts for each process account. You'll have a, process account, you'll have a normal loss account, you'll have a abnormal loss or a gain account. In your questions, the first thing that you'll be doing is draw a small working note. In that working note, you will put down the input, what is the normal loss, what is your expected output, match it with the actual output to understand whether there is any abnormal loss or gain. That is step number one. That will be made for each of the processes for us to understand which process has abnormal loss, which process has abnormal gain. Once that is done, you will start with your process account. In your process account, you will first put down to material introduced. Always keep this in mind. Only the material introduced will have your units. No other cost will have the units. Only the material introduced will have units and amount. And then you will put down all the expenses. There could be labor, variable overhead, direct expense, etc., etc. Okay, so you'll fill up all the debit sides, whatever is given in the question, and on the credit side, you'll write by normal loss. By normal loss, in that you'll put down the number of units and you'll put down the scrap value of it. Please keep it in mind, it has to be at scrap value. Once you fill up this much, that is, you put down all the debits and you put down minus the normal loss at scrap value, you will come below the table sorry, but you will come below the process account, and over there you will find out something called as your expected cost per unit. How do you get your expected cost per unit? It is all of the costs that you've written on the debit side minus the scrap value on the credit side and divided by the number of units that you have written on the debit side minus the scrap value units. Okay, so it is cost per unit basically. So on the debit side, you on the numerator you have the total cost, on the denominator you have the total units. You'll put down all of them, you will get your cost per unit. Okay, now, once you get your cost per unit, you will have one the output transfer for sure, and then you may have abnormal loss as well or abnormal gain. All of these three items has to be as per the expected cost per unit. So, which is why output, abnormal loss, and abnormal gain has to be at expected cost. But normal loss will always and always be at scrap value. Keep that thing in mind. Now, in case you have abnormal loss, what are the two accounts you will be creating? You will be creating a normal loss account and you will be creating an abnormal loss account. Okay, so in the normal loss account, you will have the one entry coming from your process account over here. Okay, and what is the fate of these units? These units have anyways gone bad. So, what do you do with bad units? You just sell them off. So, you will collect cash. The amount will be at scrap value, everything at scrap value, one entry on the debit, one entry on the credit, and that's it. Okay, that will be all. On the credit side, on the sorry, on the next account, that is your abnormal loss account, you'll have one entry which will come from the process account. Okay, one entry coming from the process account. Now, these units have also gone bad. These are also useless. If they are useless, what do? You just sell them off and collect cash. You will collect scrap at it. So you will get the units from the process account, that is your abnormal loss. You will collect cash by selling them, and now whatever is the difference is your profit or loss, which is always going to be a loss. So for example, if the expected cost per unit is 10, you collected scrap value only 30, so what is the balance? 80, that is your loss. Are we understanding? So this is your basic process account when there is an abnormal loss. Now, in case you have an abnormal gain, a very important, please pay attention. In case you have an abnormal gain, you will still have one entry coming from a process account. From by normal loss, you'll have one entry coming over here. Okay, that much you'll have, but you'll have to understand this one thing. In case of abnormal loss, in case of abnormal gain, you actually have not lost those many number of units. Remember, I used to keep telling you, abnormal gain is basically reduction in normal loss. You were expecting to lose 100 units, you did not lose those many number of units. That's why there is a gain. So here, for example, let's say the normal loss was expected to be 100, but you have an abnormal gain of 30 units, meaning you did not lose 100 units. You have lost only 70 units. Those 30 units that you haven't lost, that will not be sold at scrap, because unless and until you have lost those, how can you sell them at scrap? Are you understanding? So let's say this is 100 units at 2, and these are 30 units. So you haven't lost these 30 units. You have actually lost only 70 of them. Now, if you've lost only 70 units, those are the only units you will collect at scrap value and get it. But what do you do with these 30 units then? These units will be sent to the abnormal gain account at what value? At scrap value, which is 2. Why? Because that is the value at which it came into the process account. So that is the value it will exit the process account as well. So 100 units came in the process normal loss account at 2 rupees. You have spoiled only 70 units. So you will sell those 70 units, collect cash, and it is done. And the abnormal gain will be out of the balance, which is the 30 units. You will sell them, send it to the abnormal gain account. Now, in your abnormal gain account, you will have two accounts, two entries, one coming from the normal loss account, and the other, which is from over here, from the process account to over here. Okay, so you will have both the entries coming in. The only difference that you have will go to costing PNL. in an abnormal gain, it will always be a gain because it is a benefit, and in the abnormal loss, it will always be on the loss side. So if you are making an abnormal gain account, it will be to costing P&L. If you are making an abnormal loss account, it will be by costing P&L. Okay, it has to go, if it is a loss, it has to go on the debit side of costing P&L. If it is a gain, it has to go on the credit side of costing P&L. Okay, now this is your basic process account. Then comes in the equivalent production, the very, very interesting five-step equivalent production. We'll first talk about weighted average, and then we'll come to FIFO. When do you have to use equivalent production? Very, very important. So equivalent production has to be used only and only when you have opening or closing WIP. If you do not have opening closing WIP, then all of this is a waste. You will be doing basic process account. You will be doing equivalent production only and only when there is an abnormal loss or gain. Sorry, opening or closing WIP that has happened. Okay. Now, if there are opening closing WIP, then what do you do is what we are trying to understand. Now, in that you have equivalent production. That's step number one. Now, for the first step, you are trying to find abnormal loss or gain. Okay. Now, in this abnormal loss or gain, you will start off with the opening WIP, whatever units that you have introduced. Together, we call it as units in production and units in process. Sorry. In that, you will reduce your normal loss. Now, once you reduce your normal loss, you get your expected output. We branch it out into three branches. We will have transfer, closing, and abnormal loss or gain. Okay, I'm repeating. You will start off with opening WIP. Add the introduce, you will get units and process. To the units in process, you will reduce the normal loss, you will get your expected output, and that expected output spanned into three branches: transfer, closing, and abnormal loss or gain. Now, if you are following FIFO, sorry, if you are following weighted average, okay, you will have three branches in your step number two, that is statement of equivalent production. Okay, three branches, which one? The transfer, closing, and abnormal loss or gain. See, keep this in mind. 1 minute. You have made three branches here. Okay, those are the three that you will have over here. Now, just in case it so happens that you do not have a normal loss, okay, then you will have only two branches over here: unit transferred and closing. If you have no, you will have two for sure. You will have unit transferred and closing stock for sure. Okay, so you if you have only two branches, you will make two particulars over here. If you have three branches, that is closing, abnormal loss or gain, or you have units transfer and units transferred. In that situation, you will have three branches over here. So two or three branches is purely circumstantial to the question. Okay, now the units transferred will always have a degree of completion of 100% across all the materials. Material, labor, overhead, those are maximum three that you can have, but you may have material and conversion cost as two, or you may have just a cost. Okay, so it both all the three are possible. You can have material, labor, overhead, you can have material and conversion, or you can have just cost. Okay, now so units transferred will always and always have 100% degree of completion everywhere. Then you have closing, the degree of completion will be given. Abnormal loss, the degree of completion will be given. If it is not given, then we assume 100%. And if there is an abnormal gain, if there is an abnormal gain, it will be in the negative in bracket and across 100%. In the bracket across 100%. Okay. Now, step number three, if you are doing weighted average, it will be opening cost plus current cost divided by minus scrap value of normal loss divided by the equivalent units. Okay, so opening cost plus current cost minus scrap value of normal loss divided by equivalent units. Please keep it in mind, the scrap value of normal loss has to be reduced only and only in material, because that is the thing that you scrap. Okay, you do not scrap labor overhead, so do not do that. Okay, then the next step comes in the valuation. Now the valuation are very simple. All you have to do is whatever is the transfer, or whatever branches you particulars you made. So over here you made these three particulars. These are the three which will get the valuation. Now the valuation criteria is simple. Whatever are the equivalent units into cost per unit. Okay. Whatever are the equivalent units into cost per unit is what you have to do. And lastly, you have the process account. Okay, very logical steps. Do these steps properly, you will not be finding problem in any of the questions. Okay, now when it comes to FIFO, okay, now only thing extra that you will be doing in FIFO is in the units transferred, you will have opening stock and UICT. I am repeating UICT. UICT stands for units introduced, completed and transferred. So opening stock and UICT. Okay. So now you will have four particulars. In case of FIFO, you will have opening stock, UICT, closing stock, and abnormal loss or gain. Okay. So now these four particulars are maximum. You can have minimum three, that is opening stock and UICT would be there for sure, and then you may have closing stock. You may not have abnormal loss or gain. Okay, so that's the thing that you can have. Now very important is to figure out and understand and realize is that the opening stock will always and always be given the balance percentage. For example, if the material is 60% complete in opening stock, if it is already 60% complete, see, we are trying to finish the material. Okay, we are trying to finish off the material. So when we are finishing the material, it will be whatever is already done is done, whatever is further to be done is what you have to add up. So that was 60% already. Now you will be putting in the balance percentage of 40. So you'll put down the balance 40% over here. Okay, so opening stock will put down the balance percentage. UICT always and always 100%. And abnormal loss will be again the same rule. If it is mentioned in that, if it is not, then it will be 100%. And closing stock, the percentages will be given. So always remember the opening stock in the opening stock, it will always and always be the balance percentage. Are we clear? It will never be the percentages given, it will always and always be the balance percentage. Okay, now as far as cost per unit goes, in FIFO, your cost per unit is only current cost minus scrap value of normal loss upon equivalent units. Okay, only that much. It will not be anything different. You will not add your opening cost over here. Opening cost happens only in weighted average. In FIFO, you will do opening cost plus current cost. Okay, then the valuation is what you'll have to keep it in mind for the transfer. The transfer valuation is important. Transfer is made up of two elements, opening stock and UICT. Now, the opening stock, we have to first add the opening cost. Opening cost is the cost that we had already incurred in the past. That plus whatever you have incurred in the present. So whatever are the equivalent units of opening stock into the cost per unit of the present, plus along with that you will also have to include the past cost, which is the opening cost of it. So you'll have to include both of them, that plus whatever is the transfer valuation is what you'll have to add. Both of these two things will collectively be called your transfer valuation. Okay, so the UICT plus opening stock, you add both of them, that is your transfer valuation. How do you get opening stock valuation? Whatever is the opening cost plus whatever you have introduced in this period. For opening stock, whatever are the units into the cost per unit. Okay, and the units introduced, completed and transferred, those many number of units whatever you had, the UICT units, you will multiply that with the cost per unit, the regular route, and add them together. But apart from that, the other valuations are the same. The closing stock, abnormal loss, all of those valuations are the same. There is no difference over there. Okay, and yeah, that's what you have for um the equivalent production. Just remember these five steps, you'll be able to score good marks, perfect marks in this particular section for sure. Now, there is one more small topic called equivalent production, inter-process profit, but it is okay if you want to take a little risk and not do it. Okay, we have already done a question on it. Feel free to have a look over there. But in case if you don't want to, it is fine. That much risk I think you should be able to carry. Okay. Now, as far as important questions go, I'm going to mark a few. I will mark for you question number 5, then 7, 8, and 9. Sorry. So four of these. Oh, out of equivalent production, you know what? You can actually choose to randomly do any three questions. See, because most of the questions are same. Okay, most of the questions are same. So you can choose to do any three. I am choosing 13 for you right now. Then this one has abnormal gain, so I'll choose 15 for you and 17 and 23 is a good question. Four questions I think should be enough. Enterprises profit it is okay if you leave them. And I wanted to do the entire miscellaneous section. Okay, uh, miscellaneous section, don't leave anything. I have left one question. No, I've done all. So those are three, four questions. Make sure you do all of them. So the summary of the chapter, you have basic process account. In that you have two types, abnormal loss and abnormal gain, and you have equivalent production. In that you have two types, FIFO and weighted average, and then you have the miscellaneous category. So only this much is your chapter. I hope you understood all of it. If you have any doubts, let me know. And until then, I'll see you for the next chapter. Okay, guys, so the next topic that we're going to do is service. Now, as far as the revision goes for service costing, there's nothing in particular that you will have to keep in mind. Although there are a few things that you should broadly understand, but nothing in particular. So, broadly, what we are trying to find is cost per unit. Now, this unit could be passenger kilometers, ton kilometers, room days, room nights, patient days, something like that. Okay, so the unit could be anything. Depending on the question, it could be any unit. And the cost will, of course, this could also be instead of cost fare. Now, when they're asking you cost, it's just the cost. When they ask you fare, it is cost plus profit. Okay, so that's the thing that you'll have to remember. But that's the broadest line of things that you are going to do in this particular topic. Now, for that, you'll have to simply do the total cost or fare upon the total number of units. Now, when you have this total cost or fare, things that you'll have to keep in mind while solving that is first is the time frame. Whether you're going to do it in days or weeks or months or year, be very, very careful for that. Acha. Many a times you will come across in the transport industry specifically that it is for one vehicle or five vehicles or 10 vehicles or 50 vehicles or something like that. So you'll have to know whether it is for one vehicle or 50 vehicles. Okay, so that is one thing that you'll have to keep in mind. So again, I am going to write number of vehicles particularly. Okay, so for what time frame and for how many vehicles? So if it is for 1 year, one vehicle, 1 year, all the vehicles, 1 year, three vehicles, something like that, and that you will divide it by the composite unit. Now, as far as the composite unit goes, it could be anything. It could be passenger kilometer, it could be ton kilometers, it could be room nights or room days, or it could be uh, patient days. All of these are possible for you. Okay. Now, the simplest way of a composite unit go by the literal verbatim of it. If you are finding passenger kilometers, literally multiply the number of passengers with the number of kilometers. It is as simple as that. Okay, but in some of the situations you'll have to be a little careful. Careful how? Let's say they are asking you to calculate ton kilometers. Okay, and they say the truck is going full while going, but while coming back, it is empty. Now, in this situation, you have 10 kilometers while going, but you will not have 10 kilometers while coming. Why? Because while going, you had both the tons and the kilometers, but while coming, you did not have tons, you only had the kilometers. You'll have to keep this in mind this way, that if I want to calculate 10 kilometers, I should be having both. I should be having the tons and I should be having the kilometers both. Only then I will have 10 kilometers in my calculation, else I will not. Okay, so you can keep it in mind that ways, that for 10 kilometers you need both the number of tons and the number of kilometers. Are we understanding? Same goes for any other, let's say for passenger kilometers. If the bus that is going is coming back empty, so the bus will have passenger kilometers while going, but will not have passenger kilometers while coming. Okay, and this kind of a situation may arise in anything and everything. So you just have to be a little vigilant, that whether you have both or not. Okay, so that's one thing that you have to keep in mind. Plus, a lot of things, small things in terms of cost could be a problem. Like, for example, fuel is one of the favorite adjustments with the institute. Okay, so fuel or diesel. So for your fuel and diesel, you will have to calculate the kilometers. Now, always I say this, go from extreme micro to macro. How much is one way? How much is a round trip? How many trips in a day so that you can get kilometers in a day? How many days in a month so that you can get kilometers in a month? And how many days in a year so that you can get kilometers? How many months in a year so that you can get kilometers for the year? So always go from extreme micro to macro. Okay, extreme micro to macro. Only then you will be able to figure out the kilometers very correctly. Okay, the chances of errors will reduce significantly. Go from extreme micro. How much for a one-way trip? How much for a round trip? How much for a day? How much for a month? How much for a year? Okay, that ways you'll ever not have a mistake in your calculation. Okay. So that is one thing that you'll have to keep in mind. Apart from that, we have very small adjustments like commission and all. Okay, they say commission is 10% of takings, 15% of taking, something like that. So in this situation, what do? We assume the takings to be X. Okay, and then if the commission is 10% on taking, so we put that as 0.1x. That ways we are able to solve the entire equation. Uh, The next set of questions that we did, they were hotels. Now, under hotels, you only have to keep in mind one thing. The room days, it is the number of rooms occupied for the number of days. Okay, so like that, you'll have to keep it in mind while you're calculating your room days. The number of rooms that were occupied for the number of days. We have season, off season calculations there, so be a little careful there. Also, the rent calculations that you have under hotels. So there are, if there are multiple categories of room, we say the single room is X per day. So double room is 2x per day. Triple room is 3x per day. Something like that. Okay, so like that, be a little careful while just figuring out the rent. Okay, because we assume these to be per day. Okay, so if these are for a day, then into the number of days, into number of months, and all of that to get your annual ones. Okay, from the last section, you have the smaller questions, different ones. You have toll and life insurance and hospital. Okay, those are again very simple questions, nothing to worry about. So, all in all, if I have to tell you where are or what is it that you have to keep in mind when it comes to service costing, is just this much. Be careful of the time frame. Be careful with the number of composite units. It's basically passenger kilometers would require both the number of passengers and the number of kilometers. Okay, if you do not have the number of passengers while coming in, so the passenger kilometers while coming in will become zero. Okay, so be a little careful there. Now, In terms of important questions, I don't find the first three questions that are worth doing the one day before exam. But I think you can do question number eight. That's a decent one. Where is no, no, sorry. The eighth one. The tenth is a good question. Um, 13 question, wrong solution question. You can pick up a school question, either 14 or 15, whichever you like. 16, yes, you'll have to do that. From the hotel services, I would suggest you do two questions. Question number 20 and 22. Okay, they will cover most of your adjustments. And you can pick up 25. It's a very small question, you get over easily. Nothing from the toll area. I mean, toll is very simple. 28th question. And you can quickly brush through the 30th question just so that you understand what are the different types of adjustments in it and just work out the adjustments roughly. That's all. That's all. Okay. So yeah, that's it from this chapter. Give me a moment. I'll join you with the next one. Now, the next topic is standard costing. Very, very formula driven here. I'm sure this would be one of the topics which are sailing smooth for you because we've devised the formulas in such a way. The only thing that you have to actually put in skill and effort into putting is the standard. The important part is to fill up the standard. I think if you get that right, filling in the variances, I'm sure with the number of questions that we've done, it is not going to be that big a challenge. But the fill up of the standard is where the skill and art is. So we'll just quickly revise through everything that you should be keeping in mind before you actually start doing the questions or things to be kept in mind to avoid making mistakes. Okay. Now, the material, labor, and variable overheads are variable cost variances, and of course, the fixed overheads are fixed cost variances. Okay. Now, when it comes to material labor overhead, it is always and always based on actual output. When they say actual output, meaning what? Let's say the actual output is 1000 units. So we are basing our standard. We are basing our standard based on 1000 units. That for 1000 units, how much is the quantity that you should have put in, at what rate you should have got the material, and what has to be the amount for that. Okay, that is for 1000 units. Whatever you have actually produced, whatever is actually produced, for that, what is to be the first um, quantity, or what has to be the quantity that has to be put in, is what you're trying to understand. So if at all the actual output is 1000 units, so for 1000 units, how many kgs of raw material should have been used? Let's say it says 4 kgs. So if one finished goods require 4 kgs of raw material, so 1,000 finished goods will require 4,000 kgs of raw material. That is what will become the standard. And then you will be drawing up the actual. The actuals are usually given in the question. If not, they will give you ways to figure out the actual. Okay. So the quantity, rate, and amount. But the important element is the standard quantities, rate, and amount. The standard for 1000 units has to be so the standard has to be for based on actual output, and whatever is the actual output, for that how many kgs should be required is what is going to be the standard. Okay, so for that much actual output, what is the standard needed versus what is the actual. So basically, we are keeping the actual output as a base to compare the standard and the actual. Okay, so keep that in mind. Now, When it comes to solving the variances, they're pretty much the same. You have the material cost variance split up between material rate variance and material usage variance. The usage variance further split up between material mix variance and material yield variance. Okay, so that's the entire run up of things that you have. Okay, now when you have the material cost variance, it is basically the differences between the standard cost and actual cost. In your rate variance, it is the difference between the standard rate and actual rate. But always keep this in mind. I've been telling you when we were solving as well that you have to get the answer in an amount. So if the bracket has rates, you multiply with the quantity. If the bracket has quantity, you multiply with the rate. So now we have a rate over here in the bracket. You are going to multiply this by actual quantity. And in the usage variance, you take out the difference between the quantity. Now, since in the bracket you have the quantity, you multiply it with the rate. Okay. Now, the material mix variance and the material yield variance is what you will have to work out. The material yield variance is simpler. Total standard quantity minus total actual quantity into the weighted average standard rate. Okay. And the mix variance, you remember we find out the proportionate quantity, that is the total standard quantity. Sorry, the total actual quantity into the standard mix, that minus the actual quantity into the standard rate. Why standard rate? These are sub variances of the usage variance. The usage variance is multiplied by standard rate, so the sub variances are also multiplied by standard rate. Okay, so that is why the standard rate. Now, things to be kept in mind over here. Firstly, the mix variance and the yield variance is only and only possible when you have more than one material. Okay, so if you have only one material, one type of material, you'll have only three variances, the first three: cost, rate, and usage. But if you have more than one material, is when the usage gets further split into mix and the yield variance. Okay. Uh, Apart from that, only thing that you'll have to keep in mind is drawing up the standard quantities and rates. Okay, these are the only things important from the material perspective. The actuals 9 or 10 times will be given. You don't have to worry a lot. Okay. Now, when it comes to labor, it is exactly the same thing and absolutely exactly same thing. The only difference is in the standard, instead of drawing up the quantity, rate, and amount, you will be drawing up R as a rate and amount. The actual R is the rate and amount. Okay. And there is one slight change when it comes to the variances. You have labor cost variance, labor rate variance, then you have labor idle time variance, and then labor efficiency variance. Okay, now this is when you have only one grade of labor. If you have only one grade of labor, this is what is going to happen. If you have multiple grades of labor, so it will be cost, labor rate, labor time variance. Okay, this is going to be labor time variance. This is idle time variance. Then it is the mix variance and the efficiency variance. Now, what do you have to keep in mind with this spectrum? The idle time. Okay, if the question specifically says idle time, only then you will have an idle time. Otherwise, you don't have an idle time. You cannot assume there was an idle time. The question will have to tell you that there was an idle time. Only then you can figure out the idle time for that. Second, if you've given the idle time as a separate variance, then all the variances after the idle time variance should not have idle time in them. So for example, let's say if 100 hours were idle time, let's put some random numbers, 1800 hours. Okay. Now if this is the situation and they say actual hours had 100 hours of abnormal idle time. So you took abnormal idle time into the standard rate, whatever, and got your answer. Now, when you're calculating your efficiency variance, you will be doing 2000 hours is what you should have taken. 1800 hours is what you have actually taken, but that includes 100 hours of idle time. So even though you have 1800 hours, you will not write it down as 1800 hours. You will write 100 hours lesser. You will be writing this as 1700 hours only. Why? Because those 1800 hours had 100 hours of idle time in it. So that is already kept aside. The 1800 hours had 100 hours of idle time. So you have already recorded it separately. So you will be putting down only the balance number of hours over here. Are we understanding? So keep that thing in mind when it comes to the labor. Uh, in terms of variable overheads, they're fairly simple. Same thing, you will have variable overhead cost variance, variable overhead expenditure variance, and variable overhead efficiency variance. See, you'll have to uh, remember it this way. Do not remember where what is the name. Instead, remember what working you do in that particular block. So over here, like for example, you do standard cost minus actual cost. So keep that as the same. Okay, be it material or labor or variable overhead, that will always and always be the same. Okay. The expenditure variance, it is at the place of rate variance. So you'll do standard rate minus actual rate into actual. That is what you should be keeping in mind because the names keep on changing, but the working on that block will always and always be the same. It is actually going to remain the same. So if they are the same, then remember it that way, that you will have to only and only know at what place what working is done. Okay. Now, so you have the variable overhead cost variance, expenditure variance, and efficiency variance. Okay. Uh, Now, things to be kept in mind with variable overhead. Firstly, the variable overheads are based on laborers. Okay. So when it is based on laborers, what do you exactly mean by that? Uh, Whatever hours you've written down for labor, those are the exact same hours you have written down for variable overheads as well. Everything for variable overheads will remain the same as it is for labor. Okay. Now, when it comes to labor, uh, sorry, when it comes to variable overhead, what do you do different then? If you're writing the labor as what is different, instead of the rate of labor, you have to put down the rate of variable overhead. That's the only difference. So the bracket will still be hours rate and amount for standard and actual. But the hours will be of labor and the rate will be of variable overhead. Same thing over here. Hours will be for labor, rate will be for variable overhead. Are we understanding? So you don't have to particularly put in that many differences when it comes to the rate. This one of variable overhead, this one of labor. Keep that in mind, okay? Uh, the names, you will have only three variances in variable overhead. Always in your syllabus you have only one type of variable overhead, so it will be only three for you always. Okay, only and only three for you always. Okay. Now, last thing that you have, this is probably the important one as well. People find this a little difficult. Hopefully or not, the fixed overheads. You will have to make fixed overheads the budget and the actual. Okay. For everything of variable cost, that is material, labor, and variable overhead, you will be putting down standard and actual, but for fixed overheads, which is a time-based cost, you will be putting down budget and actual. No mistakes over there. Okay, and you will put down four elements: DHUA, days, hours, units, and amount. You may not have all the elements. Whatever you have, you put in. Whatever you don't have, just chuck it. Okay, and you will be calculating your absorption rates as well. Okay, you'll be calculating the absorption rates as well. That will be budgeted amount upon budgeted days, budgeted amount upon budgeted hours, budgeted amount upon budgeted units. Now, if you have, let's say, hours and units only, you will have two absorption rate. If you have days, hours, and units, you'll have three absorption rates. Minimum in our question bank, I think you'll have minimum two of them, but it could be maximum three. Okay, so to the max you'll have three, and to the minimum you'll have two. Okay, keep this in mind. So from two to three absorption rates you'll have. Okay, now the first variance is the fixed overhead cost variance. How do you get the fixed overhead cost variance? It is absorbed minus actual. How do you get absorbed? Absorbed is basically whatever are the actual units into absorption rate per unit minus the actual. Whatever are the actual number of units into absorption rate per unit minus the actual. Okay, so that will get you your absorbed amount. Now, if you absorb more than the actual, absorb is basically recovering. You recover more, spend less. Actual is basically spending. You recover more, spend less. What will it be? Adverse or favorable? If you recover more, great, favorable. If you recover less, loss, adverse. Okay, so consider it to be a business thing. You recover 100 rupees, but you spend 120. So you got back only 100, but you spent 120. What is that? Adverse. If you do the reverse, if you recover 100 and you spend only 80, so you got back 100, but you spent only 80. So what is it? Favorable. So keep it in mind like this. You'll be probably not having a lot of errors. Okay. Then the fixed overhead expenditure variance. The fixed overhead expenditure variance is basically the budgeted amount minus the actual amount. You spend actually more. Oh, adverse. You spend actually less, favorable. Keep it in mind. Okay. Spend more, spend less. Then the fixed overhead volume variance. What do you do under the volume variance? The budgeted units minus the actual units into absorption rate per unit. Now, how do you get the budgeted units? They are already given. Actual units already given. Now, how do you interpret this? If you are making more number of units, if you are making more number of units, favorable. If you are making lesser number of units, adverse. Okay. Now, why? See, because the cost is a fixed cost. If you're doing more number of units in the same amount of cost, it is better, it is favorable, it is fine, it is going to be helpful. If you are having lesser number of costs, okay, sorry, if you are having lesser number of units in the same cost, then it becomes adverse. Okay, more number of units favorable, lesser number of units adverse. Are we clear? So if you're doing more units, if the actual units are more, then favorable. Are you understanding? Then you have three sub-variances for this. You have the calendar, the capacity, and the efficiency. Now, what do you do under the calendar variance? It is the difference between the days. So, budgeted days minus the actual days into absorption rate per day. Okay. Capacity is interesting. Capacity and efficiency, pay attention. So, what do we do under capacity? We write standard hours for actual days. For example, the budgeted days were 20, actual days were 18, budgeted hours were 2000, and actual hours are 2100. Now, you are expected to work 2000 hours in 20 days. Okay. But you haven't worked for 20 days. You have worked for only 18 days. So can I expect 2000 hours from you right now? No, no. Because you aren't working for those 20 days. You have worked only for 18 days. So in that situation, what happens is we cross multiply. That if 2000 hours are in 20 days, in 18 days, how many? Okay. So you were supposed to work for 1800 hours. You actually worked for 2100 hours into the absorption rate. Acha, how do you choose the absorption rate? It is dependent on what you have in the bracket. So if in the bracket you have days, so you multiply with the absorption rate per day. If in the bracket you have hours, you multiply it with the hours. And if in the bracket you have units, you multiply it with absorption rate per unit. Here we have the hours, so you will multiply with absorption rate per hour. Okay. Now, lastly, the efficiency run. I'm going to come back to discuss the adverse and favorable. Okay. The if your efficiency variance, what do we write here? Standard hours for actual output minus the actual output. Standard hours for actual output minus the actual output. Now, what do you mean by that? Let's say these were 1000 units. These are 1200 units. Okay. Now, now for 1000 units, you were supposed to take 2000 hours. So for 1200 units, you were supposed to take how many hours? If for 1000 units, you were supposed to take 2000 hours. So for 1200 units, you were supposed to take how many hours? So here it comes to 2400. Okay, you were supposed to take 2400 hours. Again, you will multiply with the absorption rate per hour. Okay. Now, when you're doing this, the adverse and favorable becomes a little challenging for a lot of people. Let me try and get you the best possible way. We have discussed this in class as well. uh, Consider yourself studying. Okay, consider yourself studying. You were supposed to study for 20 days. You actually studied for 21 days. You studied for more number of days. If you studied for more number of days, will it be adverse or favorable? Of course, it will be favorable. Why? More days to study, more studying, and more studying means more chances of you having a positive. Okay. Similar is the case with the capacity variance. You were supposed to study for 1800 hours. You studied for 2100 hours. Okay, you were supposed to study for 1800 hours, but you actually studied 2100 hours. In that situation, what will it be? It will become favorable. Okay. Efficiency variance, finally. To complete the syllabus, you were supposed to take 2400 hours. To complete the syllabus, you were supposed to take 2400 hours, but you've actually taken how many hours? 2100 only. To complete the syllabus, you should have taken 2400 hours, but you have actually taken only 2100 hours. Okay. So to complete the syllabus, you've taken lesser number of hours to complete it. Okay. You were supposed to take 2400 hours, but you actually took only 2100 hours. What will you consider this? Adverse or favorable? This will be favorable. Why? Because you took lesser time to complete the syllabus. See, understand. I'll recap. More days to study, good. More hours of studying, good. but you take more time to complete the syllabus, bad. Okay, so more days to study for calendar, good, favorable. More hours to study for capacity, good, favorable. But more hours to complete the syllabus, bad for efficiency balance. Are we understanding? That's what you'll have to keep in mind when it comes to fixed overheads. Now, in terms of the important questions, let's quickly have it. I think question number three will become one all-inclusive question for you to practice per se. So you can take up that. Definitely do the sixth question. Um, 10th, very good question. You should do the 11th one as well. Then 16 and 17, no, 16 and 18 would be my recommendation for labor. Um, for overheads, you can pick up 21, 24, 25. You pick up the all variances question. You can, in fact, out of all variances, just do one, anyone that you like. Okay, just do one for your practice. You can pick up this, the sales variance, just to have a quick glimpse of things. The 36 question, once again, my pencil is out of battery. 36, and definitely do the 30th and the 39th question for sure. 38 and 39 for sure. Practice them a day before exam, and 36 question also. I think that should be all from the standard versing portion. I will see you with the next topic. So now the last topic that we have with us is marginal costing. And you all know this is my personal favorite. When it comes to things to remember in this particular topic, the things are very, very basic to remember. I'll quickly revise everything that we have, summarize it, and present it to you. First, the format. We'll have sales, variable cost, contribution, fixed cost, and profit. Sales is selling price per unit into number of units. Variable cost is variable cost per unit into number of units. Contribution per unit into number of units. Fixed cost and profit are always on totality basis. Okay, always remember this. The selling price per unit and sales are different. Variable cost per unit and variable costs are different. Contribution per unit and contribution are different. The per unit and the totality are different. Then formulas. PV ratio formula. It can be either selling price per unit, oh sorry, contribution per unit upon selling price per unit into 100, or contribution upon sales into 100. This could be one of it. We have many other formulas. We'll keep revising them as and when we go. Break-even point. If you are finding break-even point in units, it is fixed cost upon contribution per unit, or uh, you can also do break-even sales. The break-even sales will be either the break-even point in units into selling price per unit, or or it'll be uh, fixed cost upon PV ratio. We'll come back to this formula in a while. Okay. MOS sales, total sales upon minus break-even sales are MOS sales. Okay. Then our classic chart, the homegrown chart, your total sales are divided into two parts, the break-even sales and MOS sales. Break-even sales is into PV ratio is fixed cost. MOS sales into PV ratio is profit. ठीक है. Now, If break-even sales are 40%, the balance 60% has to be MOS sales. If PV ratio is 30%, the balance is variable cost at 70%. Keep that in mind. Total sales split into break-even sales and MOS sales. Now, some specific things that you will have to remember. Never express your variable cost on total basis. Never express your fixed cost on per unit basis. If you have been given variable cost on totality, first convert them into per unit. If you have been given fixed cost on a per unit, then multiply it with the number of units for which it is given, find the total fixed cost. These two things non-negotiable. Okay. Then comes in the next part where you will be asked the X calculations. Okay. Sales to earn a profit of 10% on sales. How many units will be sold to earn a profit of 10% on sales? Something like that. All of those things are also being asked. So I'll call them the X questions. Now, while you're doing the X questions, there has to be one thing which is missing. Either the selling price per unit will be missing, or the number of units would be missing. Okay, whatever is given, the balance has to be X. So if the selling price per unit is given, then consider the units to be as X. If the units are given, consider the selling price per unit as X. Wait, as simple as that. Then, when will the PV ratio change? When will the PV ratio change? Either the selling price on a per unit basis, or variable cost on a per unit basis, or contribution on a per unit basis. Very important, on a per unit basis. Unless and until these do not change on a per unit basis, your PV ratio remains intact. Okay, your PV ratio will remain intact. Also, when you're doing this chart, okay, this 40% and 60% is valid only and only till the time your total sales are the same. If your total sales are changing, either increasing or reducing, the break-even sales will still be same in terms of amount, but it will not be 40%. I remember this one question, you have break-even sales of 12,50,000, total sales are 20 lakhs, something like that. Okay, and MOS sales will automatically become 7,50,000. Now, if the break-even sales increase, if the total sales increases by 7.5%, okay, that would mean the sales are increasing. Now, since the sales are increasing, the 40% and 60% is no longer applicable. But the break-even sales are still 12,50,000 in terms of amount. So they are not 40% of total sales, but they are still 12,50,000. Please get that in your mind. Why? Because break-even sales is by what? How do you get break-even sales? It is fixed cost divided by PV ratio. Now, neither the fixed cost has changed, neither the PV ratio has changed. Since nothing of it is changed, the break-even sales will remain the same. Yeah? Are we understanding? So, in terms of amount, they're still the same, but in terms of percentage, they're not the same. Okay, same thing over here. Unless and until the selling price per unit or variable cost per unit or contribution per unit does not change, it could one of them could change, all of them could change, few of them could change. Anything happens in change, then your PV ratio has to automatically change. Please keep that in mind. Till that time, the PV ratio remains the same. Till that time, the PV ratio remains constant. So you will have to have the same PV ratio till the time the per units are not changing. Okay. Apart from that, the decision making section is important. I will quickly list out the important questions for you, but these are the only things that you actually have to keep in mind. When does the fixed cost remain the same? When does the PV ratio remain the same? When does the break-even sales and MOS sales remains the same? The chart, the format. That's all. Whenever you've been asked a question, and if you are confused, try filling up the format. Fill up everything that you know in the format. You'll automatically get the answer. Okay, it is as simple as that. And of course, you have the change formulas. So you got change in profit upon change in sales into 100 to get PV ratio, and change in total cost upon change in units to get variable cost per unit. Once you get your variable cost per unit, you will substitute it and find your fixed cost as well. That's all you have to keep in mind in this particular chapter. This much will enable you to solve any question. The rules remain the same. Do not tamper the rules. Once you keep the rules correct, your answer will be found automatically. Okay. Now, let's quickly note through the important questions. Um, I think you can have this question. It's a very basic question, but it'll help you, just brush up. Then, no, this is a nice question. You can do this. Out of the change formula question, you can pick up any two. Whatever you like, you can pick up any two and solve it. I am not going to give any preferences. This question important for the third burner, the shutdown point only. Uh, Give me this to practice. You can do this. This one. This is a good question. This mm, maximum, it's okay. This one, this one. Um, I can do this. This. Uh, this. This. That's oh, of course. And last two, important. So that's it from the number of questions in this chapter are higher, of course, because it's an important one. But I'm sure you realize that the time that it takes to solve the question in this particular chapter are also less. So this is all that I think you should practice a day before exam, so that it'll become a little easier for you to, just get a hang of the entire set of questions. Okay, so that's it from my end. All the very best, and if you have any queries, do send me a message. Thank you.